Accounting's finance, the hidden engines behind every business. Welcome to Learning Bites. Every successful business, from a small local shop to giant corporations like Apple and Microsoft, depends on two critical functions: accounting and finance. Many people think they are the same thing. Some even use the terms interchangeably. But here's the truth. Accounting and finance serve completely different purposes. One tells you where the money has been. The other helps decide where the money should go. Together, they form the foundation of every successful organization. In today's video, we'll answer 3 important questions. What is accounting? What is an account? And what is the difference between accounting and finance? Let's begin. Chapter Ec. What is an account? Before understanding accounting, we first need to understand what an account actually is. An account is simply a record of financial transactions related to a specific item. Think of it like a folder. Each folder stores information about a specific category. For example, a cash account records all cash transactions. A sales account records all sales transactions. A salary expense account records employee salary payments. An inventory account records stock movements. Every transaction enters one or more accounts. Without accounts, businesses would have no organized way to track money. Example: imagine you own a grocery store. A customer buys products worth =taka. The transaction affects 2 accounts. Cash account increases. Sales account increases. Both accounts help explain exactly what happened. On-screen text. Account: a record of financial transactions. Chapter 2. What is accounting? Now let's move to accounting. Accounting is the process of recording, classifying, summarizing, analyzing, and reporting financial transactions. In simple words, accounting tells the financial story of a business. Every sale, every purchase, every loan, every payment, every expense must be recorded accurately. The purpose is to provide reliable financial information for decision-making. Accounting cycle: animation, transaction, journal entry, ledger, trial balance, financial statements, decision-making. Accounting helps answer questions like: how much profit did we make? How much cash do we have? What do we owe suppliers? How much do customers owe us? Is the business growing? Without accounting, managers would be making decisions blindly. Main objectives of accounting. Accounting serves 5 major purposes. First, recording transactions. Second, measuring business performance. Third, monitoring assets and liabilities. Fourth, preparing financial statements. And fifth, supporting business decisions. Chapter 10. Types of accounting. Financial accounting. Used for external reporting. Processes. Balance sheet, income statement, cash flow statement, management accounting. Used internally by managers. Helps in budgeting, forecasting, cost control. Cost accounting focuses on production costs. Helps companies calculate product profitability. Tax accounting deals with tax regulations and compliance. Auditing verifies that financial information is accurate and reliable. Chapter 4. What is finance? While accounting focuses on the past and present, finance focuses on the future. Finance is the science of managing money and making investment decisions. It involves raising funds, investing funds, managing risk, allocating capital, and maximizing value. Finance helps businesses answer questions like: should we build a new factory? Should we purchase new equipment? Should we borrow money? Should we invest in a new market? How can we increase shareholder value? Funding, investment, returns, growth. Chapter Parts, Types of Finance. Personal finance. Managing individual finances. Examples: savings, retirement planning, personal investments, budgeting, public finance, government revenues and expenditures, tax collection, public spending, infrastructure investment. Chapter Choi, Accounting's Finance. Accounting focuses on past and present, records transactions, prepares financial statements, tracks business performance, ensures compliance, measures results. Finance focuses on present and future, raises capital, makes investment decisions, manages risk, allocates resources, creates growth strategies. Suppose a company earned 10 million taka profit last year. Accounting's job is to accurately measure and report that 10 million taka. Finance's job is to decide what to do with that 10 million taka. Should it be invested, saved, used to repay debt, distribute to shareholders? This simple example perfectly illustrates the difference. Accounting: what happened? Finance: what should happen next? Real-world example. Imagine a company wants to build a new factory. The accounting team provides historical revenue, profit reports, cost information, cash balances. The finance team analyzes investment returns, financing options, risk factors, future profitability. Only when both departments work together can management make informed decisions. Accounting and finance are often confused, but they serve different purposes. Accounting records the financial history of a business. Finance shapes its future. Accounting provides the facts. Finance provides the strategy. Accounting asks, what happened? Finance asks, what's next? Together, they help organizations grow, invest, compete, and succeed. Whether you're a student, accountant, entrepreneur, or aspiring foe, understanding both disciplines is essential. Because every successful business stands on two financial pillars: accounting and finance.